Hi, welcome to Slay the Spider. I'm Jim B, and I'm the creator and host of Slay the Spider. Shares of the S&P 500 are called S&P Depository Receipts, SPDRs. Spiders. Slay the Spider means I intend to beat the S&P 500 quite substantially. There are three major influences on the movement of stock price, according to a study by Ben E. King. 80% of your investment success will be due to the movement of the sector and the market. Now you can view a weekly snapshot image of the market and the sectors. This is a snapshot from April 9th, 2021. The red arrow, pointing towards the 2 o'clock position, represents the market. The rectangles each represent a mini-sector. They are color-coded to the sector they represent. Healthcare mini-sectors are in red, technology is dark blue, financials are green, media communications are brown, industrials are purple, consumer discretionary are light blue, and all the others are gray. I've been charting this movement since 1998 over more than 25 cycles using this exact mix of 40 mini-sectors. The key to understanding the movement and what makes the cycle predictable are the psychological stages that investors experience as they go through complete market cycles. It rarely changes. These stages are on the outside border of the circle. The placement of the sectors and the market are completely data driven. The interpretation of what to expect next is from my experience of going through the cycle dozens of times. I'm not always perfect, but the beauty of the circle is that it corrects me quickly when I don't get my prediction absolutely correct. I've learned it's okay to be wrong now and then, but absolutely abysmal to stay wrong when the data says otherwise. The movement in the sectors this past week were mixed. First, in the health sector, biomedical declined, healthcare declined, and drugs declined. In media communications, internet stocks declined, telephones declined, and media advanced. In technology, software declined, semiconductors declined, electronics declined, and computers declined. In consumer discretionary stocks, gaming advanced, leisure advanced, restaurants were unchanged, household products were unchanged, retail rose, and the autos were unchanged. In financials, Wall Street was unchanged, real estate declined, banks rose, savings and loans rose, finance rose, and insurance advanced. In the industrials, waste advanced, machinery tools declined, steel was unchanged, metals rose, building products rose and crossed to the bull side, chemicals declined, and aero defense declined. In the other group, gas utilities declined, business products declined, electric utilities declined, textiles advanced and crossed to the bull side, protection and safety was unchanged, food declined, transports rose, precious metals declined, oil services declined, while oil rose, and forest products rose. This week, 6 mini sectors were unchanged, 15 advanced, and 19 mini sectors declined. 2 sectors crossed from the bear side to the bull side. We now have 15 sectors on the bull side and 25 on the bear side. For the week ending August 13th, all three major indexes set new highs. The Dow was up 306 points, or 0.87%. The S&P 500 was up 31 points, or 0.71%. NASDAQ for the week lost 13 points, down 0.09%. Last week, we had 3,190 stocks on buy signals. This week, 3,186. Last week, we had 3,191 stocks on sell signals. This week, 3,213. The overall market score was 53 last week and 52 this week. On Monday, the market opened down on the Afghanistan news. It rallied in the afternoon. The S&P and Dow Jones both ended at new record closes. On Tuesdays, the markets opened down, and at their worst were down about 1.5%. There have been four newsworthy events. First, Afghanistan's collapse embarrassing the U.S. with its speed and our lack of preparedness for it. Second, a fourth wave of COVID is underway, and we're getting ready to, the administration's ready to impose new restrictions, wearing masks and shutting down businesses, etc. Three, retail sales for July were rather disappointing. And fourth, the Michigan Consumer Confidence Index reported its sixth worst ever loss in the last 50 years. Apparently, Americans are not happy with the fourth COVID wave and perhaps more shutdowns. They are not confident in this administration's handling of COVID, nor the handling of Afghanistan. They are therefore not outspending as freely as before, and it's starting to show up in the retail numbers. I reran the numbers for my chart after the close on Tuesday the 17th. Since Friday, 8 sectors have crossed from the bull side to the bear side. Those sectors are real estate, telephones, steel, metals, gaming, internet, leisure, and healthcare. Semiconductors and biomedicals are also right on the brink of moving to the bear side. So there are now 7 sectors on the bull side and 33 on the bear side. The circle clearly reflects what's going on in the news and the economy. The sectors leading the way down are healthcare, due to the fourth COVID wave, and consumer discretionary, reflecting disappointing retail sales and the anticipated travel restrictions and stricter masking and vax requirements. There also seems to be a lack of confidence in the administration due to the COVID, retail sales, and the disaster in Afghanistan. Throw in Cuomo, and the Dems have been having a really rough week, not inspirational at all. Strength is in the financials and the industrials, as both had very strong earnings results, but second quarter earnings reports are now virtually totally behind us, and earnings reports won't be driving markets for another couple of months. The 4 o'clock loop downturn appears to be very close. We'll know in the next few days or perhaps the next week or two.